It's 2024, the world is buzzing with innovation, and the stock market has become a wild playground of opportunities. But the timeless art of investing, possessed by Warren Buffett, still holds the key to success. We are talking about the Oracle of Omaha himself, who defied the norms and became the greatest investor of all time. Buffett has even made it to the list of the top 10 wealthiest people in the world. So how did Buffett hit the road to riches? If you think Buffett's investment journey involves some kind of magic that turns money into gold, think again, because anyone can invest like Warren Buffett. It's just the strategy you have to pick. So let's dissect Buffett's playbook and understand his investment strategy. Known as the Oracle of Omaha, he is an American businessman and philanthropist who's considered the most successful investor of the 20th and early 21st centuries. He has amassed a personal fortune of more than $100 billion by defying the prevailing investment trends. Then how did he end up on the list of the world's richest people? From selling soft drinks to making billions of dollars, turning an ailing textile mill into the world's most successful holding company. There is so much in Buffett's brilliance to talk about. So, let's start with the success story of Warren Buffett. He was born to Howard and Layla Buffett on August 30th, 1930 in Omaha, Nebraska. Rare in his age group, making money was his biggest interest. At age 11, he made his first stock purchase. He bought 3 shares of City Service for $38 per share. His purchased stock first plunged, but then surged to $40. Buffett then quickly sold his stocks. But this was his biggest mistake, as soon after he sold, the stock price rose to $200. So the very first lesson Buffett learned was to value time and be patient. Keeping this in mind, he covered a few more important steps in his investment journey. Using the money he gathered by selling soft drinks and newspapers, he invested again in 40 acres of land and rented it for profit at 15. His academic journey was also going along. Despite being turned down by Harvard, he managed to enroll at Columbia University and study under Benjamin Graham, the founder of value investing. His time at Columbia holds great importance, as from here, his storied career set off. But you need to know that this was not an overnight success. He was navigating step by step in his career at a slower but effective pace. After rejecting him once, Benjamin Graham offered Buffett a job at the Graham-Newman Partnership firm in 1954. The underlying principle of Graham was to seek stocks selling at incredibly discounted prices, lower than their intrinsic value. But Buffett wanted to take a step further. He returned to Omaha in 1956, where he joined forces with Charlie Munger, and the duo discovered Berkshire Hathaway, a dying textile mill. But this value play turned into a long-term investment when the business started showing some signs of life. Though the textile business eventually shut down in 1985, he continued using the name, and the world saw Berkshire Hathaway grow into a multi-billion-dollar holding company. But how did he turn a struggling company into a financial powerhouse? Back in 1962, Berkshire Hathaway was like an underdog in a tough textile game. But the stock's low cost compared to its book value lured Buffett in, and by 1965 he had taken control. Shares were a mere $8 at the start, jumping to almost $20 in the late 60s when he assumed the role of CEO. Buffett didn't just sit on his hands. He used the textile company's profits to acquire other businesses, creating a money-making domino effect. By 1969, he had wrapped up his investment partnerships, offering Berkshire Hathaway shares instead of cash. Then, like a financial maestro, he scooped up insurance companies, turning them into wholly owned subsidiaries under the Berkshire umbrella. Today, Berkshire Hathaway Class A stock is soaring above $550,000. In 1972, Buffett bought See's Candy, but his shopping spree didn't stop there. American Express, Bank of America, Coca-Cola, Apple, the list goes on. He had a thing for sturdy brands and businesses with an unshakable economic moat. He looks for innovative, shareholder-focused management and high profit margins, and snatches up solid fundamentals at a discount. Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In 2024, when everyone is chasing the next big thing, the Oracle will remain a beacon of patience and calculated moves. But the best part is that you can also invest like Warren Buffett. You just have to absorb the essence of his investment strategy. So Warren Buffett's investment strategy was founded on one principle, which was to invest in business and not stock. Investing is a lot like building a house. You need a solid foundation, and for Buffett, that foundation is a company's fundamentals. He only hunts for well-managed, undervalued companies with a competitive advantage. Coca-Cola, American Express, and Costco ticked all his boxes and have been steadfast members of Berkshire Hathaway's portfolio for years. Buffett says he buys what he knows. That's why Berkshire is the biggest shareholder in Coca-Cola and Kraft Heinz. Buffett's aura stayed strong until tech stocks gained popularity. Being a steadfast technophobe, he chose to stay on the sidelines during the late 1990s tech stock boom. By sticking to his principles and avoiding investments that didn't align with his criteria, Buffett faced criticism from Wall Street. Many wrote him off, thinking his time had come and gone. However, when the dot-com bubble burst, causing a tech wreck, the experts who scorned Buffett found themselves bankrupt. Meanwhile, Buffett's profits doubled. Sometimes, staying true to your beliefs pays off big time. Though he missed out on some big wins, like passing Google and Tesla, and was very late to show interest in Amazon, Buffett says, missing out on 90% of the stuff does not matter if the 10% you do is right. Don't feel disappointed if the stocks you missed have gone well. What matters is how solid your operation is. Are the companies you invest in healthy overall? Do they have a sensible game plan? So prefer quality over quantity to get positive outcomes. Besides, Buffett's strategy screams to stay away from fads and FOMO. Buffett pointed out that short-term trades might give you a rush, but they can also result in regrettable decisions and nibble away at your funds with those additional fees. In his 1996 letter to shareholders, Buffett said, "If you are not willing to hold a stock for 10 years, don't ever think of owning it for 10 minutes. This means to take a breath, take a long game, and watch your money pile up." Compounding is not a fancy word. It's your best bet for building wealth. And of course, don't throw money into the market impulsively. Invest with a plan, do your homework, and ensure you're getting value. It's about being smart with your money, not just fast. And don't you think today's investing has become easier than before? Now we have even more accessibility. Thanks to the internet revolution, the cost of buying and selling shares has significantly decreased, making it more feasible for investors, especially with aggregated orders reducing transaction costs. The availability of information has also surged. With market predictions and technical analysis, we can interpret the trends and make informed investment choices. Warren Buffett achieved investment success without the accessibility and information resources available today. If he could make his investments shine in a less connected world, why can't we, with the abundance of resources and opportunities at our disposal?